A lot of contributors here, folks. Let me begin with you, David. As you look at the text of what Chair Powell said, was there anything that stood out to you, anything that was sort of unexpected?
I don't think there was much unexpected. I think he made clear that they're not going to cut rates anytime soon. The choice is between raising them a little more or holding them higher for longer. He used the word carefully a couple times. I think that's code word for don't expect a rate hike in September. And I think he made clear that the labor market is really important here. He referred to the vacancy to unemployment ratio. He said that the unemployment rate has to go up a little bit. So I think what they're looking for is some softening in the labor market to give them confidence that they've already raised rates enough. He said in the quote you use, it's a risk management. What that means is that a year ago, they said we have to raise rates to fight inflation. Now things are a much closer call, and we have to decide what's the bigger risk, too much inflation or an unnecessary recession.
Ron, do you see him as more bullish or less or more bearish than you expected here? And was there anything in his remarks that led you to believe that they're close to done?
Yeah, I mean, I think, as David suggested, I mean, they're going to be careful, and so that sounds closer to done. Although he's struck, to me anyway, a slightly more hawkish tone than I would have expected, focusing, as David said, on the labor market. I tend not to agree that wages cause inflation. They might be a symptom of it if prices rise faster than wages. That's not happening right now. So this kind of preoccupation with the strength in the labor market at a time when, you know, we are seeing some important increases in the bottom 10% earning more than they might otherwise have, or some unions getting better deals after 40 years of capital outperforming labor. To me, that's still a catch-up, and I don't think it's the type of problem that he or folks like Larry Summers continue to describe. I think they should be closer to done, and I still think, with everything that he said today, some of the variables that they look at within the inflation components themselves will likely trend lower, not higher.
And Sarat, speaking of Larry Summers, one of the charts or columns that he had this week is making the rounds because he draws the comparison to CPI now versus in the 70s when we had this peak and then this crash, but then it went up again. Back then, oil prices tripled, and I don't know if it would take literally something of the same magnitude for us to literally follow that same trajectory upwards again.
Yeah, and I think that's the important part. The Fed does not want to fall into that mistake of what happened in the 70s. It was oil back then, but it could be something else again, right? And it could come back to be oil again. Who knows what happens, in Russia as well. But when you've got this steady increase that we've had for the last couple of years in so many input prices, commodities, it's kind of, hey, we need to wait and see. We know there's a lagged effect. So if we go too early, and even if the Fed hinted that said, hey, maybe we're going to cut rates, people are going to say, well, what are they seeing that we're not? It's not we're cutting rates because things have stabilized.
Reasons, yeah.
It's going to be, oh, God, you're seeing demand fall off or there's some issue out there. So I think staying the course and watching, because you don't want to make that mistake. You already have the credibility issue before, so let's not fall into that trap again.
Yeah,
Kelly, if I might,
go ahead.
Jump in for a second? Yeah, so that chart that you referenced about Larry Summers in the Washington Post op-ed piece, Jim Bianco did an adjustment of it. And while he agrees that we could still see inflation reaccelerate, he adjusted for the way in which inflation was calculated in the 70s versus the way it's calculated today, took into account other variables. Jim Bianco shows an entirely different chart where the analogs don't match up nearly as precisely as Larry Summers would suggest. And so I'd throw that chart out. I think it's nonsense to make that comparison with the 70s, because as you say, not only did oil prices triple in 73, they doubled again in 79. And we had massive shocks and other issues that were vastly different than the experience we're having today.